If you are looking at investment properties, you will hear the term cap rate constantly. Let us break down what it actually means. Cap rate is short for capitalization rate. It is a fundamental metric used to estimate the potential return on an investment property. To calculate it, take the net operating income, which is your income minus expenses, and divide it by the total purchase price. It tells you the rate of return you might expect if you bought the property in cash, without any mortgage financing involved. While cap rate looks at the property itself, cash-on-cash return accounts for your mortgage payments and your specific down payment. Generally, properties in riskier or older areas have higher cap rates to compensate investors for the potential for higher maintenance or vacancies. Always remember that cap rates are just one piece of the puzzle. They do not account for future renovations or changes in market rent. Use cap rates to compare properties quickly, but always perform a deeper due diligence before investing. Thanks for watching.